risk of whether there will be a bull market has been removed. That has been handed to us on a silver platter. It's proven, it's well underway, and yet you have the chance to buy all of these assets that are still at regular market valuations. And it's something I have never seen in my career. That translates to something between 6 and 8 times from the bottom of around $1,050 in this cycle. Projections show that industrial demand for silver will take up every newly mined ounce of silver on the planet. It is a generational opportunity, something we may never see again in our investing careers.
Okay, ladies and gentlemen. So today we have Brien Lundin on our show for the first time, who is the editor of goldnewsletter.com. And today we will look at the US economy, precious metals, commodities, and many other very interesting topics. So Brien, thank you so much for being here.
Great to be with you for the first time. Looking forward to our conversation.
Yes, very happy to have you on, sir. So much happening right now, but I like to start by looking at the macro picture. So if we look at the US economy, what would be some of the things that you are particularly paying attention to right now?
Yeah, I think that we're looking at, broadly speaking, a slowdown in employment. I think we're looking at persistent inflationary pressures, a lot of that due to tariffs. At least the Fed is using that excuse as a reason why it may be transient again. And so I think their concern is shifting more toward the economy, more toward employment, as opposed to inflation, which is conducive for more rate cuts, even though they are talking right now about possibly holding off a while on more rate cuts, which has sent the market into quite a titter, as we've seen, with a lot of volatility in the stock market, which I think the market is basically sending the Fed an ultimatum that we really need these rate cuts, and if you don't, we're going to throw a further tantrum and create more problems. So it's an example of the codependency between the central bank and the markets that have become so addictive to not just easy money, but ever easier money over decades. And that's where we are right now. The Fed is going to have to cut rates, and the market's trying to price that in. Trying to price it in through gold. It was pricing it in through all risk assets over the past couple of months. But the AI bubble kind of got the market top heavy, combined with the shift in rhetoric from the Fed, has created a lot of volatility. And we see that gold's correction has kind of bottomed out. And on some days, like as we're speaking, it's the one asset in favor when everything else is being seen as very risky in this kind of an environment.
Right. And if we do get this economic slowdown and potential recession, what would that mean for the stock market at the current valuation? So would you expect stock market to drop in a crash style way, or how would that look in your opinion?
Well, anything could happen. The market crashing would create a liquidity event that would clean up a lot of charts, frankly, and overvaluation in the stock market. But the market would bounce back pretty quickly because in that liquidity event would bring gold down as well, temporarily. But everything would bounce back fairly quickly because the recipe from the Fed would remain the same. It would come in with literally or figuratively oceans of liquidity. In fact, it would have to come in with a rescue operation that would be, to some degree, well, to a large degree, much more than it did the previous 2 times over the last couple of decades, the 2008 great financial crisis and COVID. That's because the markets become somewhat tolerant to the drug of monetary adrenaline, so it takes more and more of a greater dosage to get the same effect. So the Fed's going to come in and really just knock everyone's socks off with whatever the rescue operation it launches post a crash. Regardless, they are going to have to start cutting rates and lower them from these levels because of the debt service issues and how that's adding to the debt and the debt spiral that we're currently in. So if we have a kind of a slow motion recession or economic slowdown, we're still going to get that easier money policies from the Fed. That will help the stock market as it has in the past. It will really help gold as it has in the past, and all asset classes will be lifted up on that rising level of liquidity. Stock market, however, because it's already at such an overvalued level, it would really have to drop considerably to see a very strong rebound. If it doesn't drop too much, then I don't think we'll see quite the reaction that we saw post 2008 or post COVID in the stock market, in equities. I think gold, however, would benefit because that would be it would be a recognition of the debt trap that the Fed's in, and the fact that it really can't fight inflation any longer and has to return to a rate cutting cycle.
Right. So if we could talk about gold. So things have been looking very positive for gold for the past while. If we could talk about some of those fundamental reasons that you believe are pushing gold right now.
Yeah, you can't get past central bank buying. That's what launched this market. That's what has supported it. That's what's prevented the market from having any kind of a correction that would be a classical correction, according to technical analysis. We've only had two 10% drawdowns in gold during the course of this gold bull market, and previous attempts to correct have resulted primarily in just a sideways trading action in which the gold has worked off an overbought status over time rather than price. And we see the current correction bottomed out at about a 10% loss, and it looks like we're starting to exit from that correction right now. So yeah, central bank buying has been the big supporting factor, but starting around mid to late summer, we started to see Western investors finally really come into the market. They had been dipping their toes into GLD, the gold ETF, but in late summer, we saw the GDX, the index of mining stocks, start to truly outperform gold. That was a real sign that Western investors were getting involved in the market. And when that happens, we return to more of a classical type of market environment where we get more wiggles in the line, more volatility, which is exactly what we've seen. We've had days where we're down 50 and up 50 the next day, down 100 one day, up 100 one day. We had a 5% sell-off in gold, which is not that unusual a few weeks ago. But because the prices now are so high, we had something we've never seen before, a $250 down day in gold. So it's kind of what you get when you get big numbers. It seems to be shocking, but it was, only a 5% drawdown. So that's what we're getting right now. The Western investors involved, more volatility to the downside and to the upside. I think, my best guess right now, and frankly, no one really knows, but my best guess right now is that we'll continue for at least a little while yet, this kind of sideways trading action. And then there'll be some impetus, some catalyst to remind the market that we're entering another rate cutting cycle, multi-year rate cutting cycle, because President Trump's guy is going to be in the Fed next spring. So once that event, whatever it is, reminds the markets that rates are headed lower again, then gold's going to start another really powerful rally to the upside.
Right. And Brien, what would be some of the things that you will look for to determine that maybe sentiment is really, really high and it's getting close to the end of the bull market? So what things you would look for to determine that?
Well, the end of the bull market is going to be really tough to pinpoint. I think it's a multi-year bull market left. It's a bull market that's been a number of years to begin with, or so far, but I think it's got a lot left in it. Timing is always tough. I think this bull market has one of two outcomes. One is that it performs as the previous bull markets we've seen in gold, early 70s, late 70s, the 2000s. If you look at what gold did from trough to peak in those bull market environments, that translates to something between 6 and 8 times from the bottom of around $1,050 in this cycle. That means then $6,000 to $8,000 gold in that scenario. But if you look at, say, the 1970s as being one cohesive bull market from start to finish, and not two, then you look at the fact that gold in that pivotal area went up 24 times from trough to peak. That would translate in this scenario to something over $20,000, probably mid-20s for gold. That would imply that scenario, which I think is a much lower chance of happening, but still a possibility. That would imply some sort of a monetary reset with gold backing the dollar and in fact gold backing other fiat currencies as well to some degree. That would also imply a bit longer term, a longer duration to this bull market. So nobody really knows. It will be very difficult to pinpoint the top, but I think if we get up to $7,000 or $8,000 gold, we should be taking profits all along the way. But I think that's an area where I would start to get a little nervous.
Just a very quick break, guys. So I've spent the last 12 months creating this course, Wealth Building Blueprint. I've put an unbelievable amount of effort into it. I cover investing, trading, speculating, business. The course is perfect for people who are still relatively new to this wealth building process. And I also offer 3 days money back guarantee. No questions asked. If there's absolutely anything that you're not happy with, you will get your money back. There's also a private community where you can ask me any questions, you can talk between each other, you can share news and things like that. The link will be in the description. Right now the course is at a 70% discount, and let's continue with the video. That's a good point. Thanks for that. If we look at silver, so some people still see silver as very much related to gold, but others see that industrial role and they believe that plays the bigger role. So what do you believe has a bigger influence on silver? Is it still the monetary side or the industrial side?
Yeah, it's absolutely monetary. I have been dismissive of the industrial case for silver for literally decades. It really has not had a lot to do with the price. I've been firmly of the opinion that if it wasn't for silver's monetary history, that it would be selling for under $5 an ounce, and that the vast majority of its price is and always has been due to its monetary value. That said, the industrial demand for silver has been growing at such a rate that it's really having a very significant impact and will have a very significant impact on supplies. And within the next 5 years, projections now show, and these are like consensus projections, not just one, outlier. Projections show that industrial demand for silver will take up every newly mined ounce of silver on the planet. That will, in my mind, exacerbate the monetary factors that really drive the price. It's always the demand at the margin that drives the price of any commodity. The demand for a commodity above or below the current price, above or below what supplies are currently providing. And for silver, if we have that same monetary demand that I think is going to come in as it leverages gold, and yet we have supplies that are severely constrained, and the monetary demand has to bid against that industrial demand. I think it's really the stage is set for silver to outperform and exceed by a large degree its equilibrium price. That record price in constant dollars, if we look at the 1980 record of $50, which we've just exceeded nominally, in current dollars, that would be just almost exactly around $200 an ounce. I think we would get there. We would exceed that level due to monetary demand. If we have that level of monetary demand and industrial demand has taken much of the supply off the market, I think we could well exceed that.
Right. And yes, we pretty much seen that silver had that spike near the end of every single previous bull markets. So history is definitely on our side there. And if we could look at the mining stocks as well. So if we're bullish on the metals, then mining stocks in theory should look very attractive at these levels as well.
Yeah, they should, and that was the frustrating part for a good while. That was we didn't see that because central banks were buying gold hand over fist since 2023, and we did not see a commensurate reaction in the mining stocks because central banks don't buy mining stocks and central banks don't buy silver. So the traditional levers to gold were underperforming and were lagging. And they lagged a long time, and we didn't really see them start to outperform gold on a consistent basis again since the late summer, and we're seeing that now. That is a sign of Western involvement, and it's an effect of Western involvement in the markets. That's why these traditional levers have lagged, and they've made very significant moves over the past year, the past few months. Still, if you look at the price of gold and you look at in the mining stocks the margins that the producers are generating right now, they're remarkably undervalued by traditional metrics. I mean, it seems like yesterday when we were just waiting for gold to break out of that ceiling around $2,000 an ounce, $2,100, for good. And, then we hit $2,500 and it was, my God, we're off to the races. So what's happened since then has been nothing short of stunning. Even the most diehard, ardent, hair on fire gold bug would not have predicted that we would have gotten $4,000 gold and above so quickly. And in fact, at current gold prices, we were amazed at $2,500 gold. That's the profit margin for a miner right now. So their profits are over 100%, in well over 100% for every ounce of gold that they mine. That's remarkable. And if you look at the fact that most of these mining stocks have doubled, maybe tripled, it's still not in line with the kind of, or fairly priced in line with the kind of profits that they're seeing. And then if you get into the juniors, there's a number of, it's harder to measure the valuations of the juniors except against their peers and some other metrics like market cap for per ounce in the ground. If we look at it from those levels, we see that the juniors, the exploration and development companies, have largely gone up 2 or 3 times from their lows, but they're still trading at normal valuations for a normal market. They're not trading at overbought levels or very high levels, high valuations for a raging bull market in the metals like we have right now. So there's still tremendous opportunity out there, really across the spectrum. And it's a real advantage that we've been handed by the markets. The risk of whether there will be a bull market has been removed. That has been handed to us on a silver platter. Here is a gold bull market. It's proven, it's well underway, and yet you have the chance to buy all of these assets that are still at regular market valuations. And it's something I have never seen in my career, this kind of opportunity.
And would you be more focused on the producers or the juniors? So do you believe the risk to reward would be on the producer side?
Well, I think that there's a lot of potential in the producers. In Gold Newsletter, we tend to focus on, further down the food chain, on the explorers, into the developers. We like to look for those really explosive new opportunities. And, we found them in recent years. We found them in recent decades. Stocks that have gone up, 10, 20, 30, 40, even as much as 85 times from our entry level. So that's pretty addicting in itself. That's a lot of fun. And so we have focused on that area. That said, the majors right now, I think, offer a remarkable risk reward scenario. They are going to go higher. They are going to go considerably higher, even after the moves that they've made. And they offer, I think, less downside risk. That said, we don't really, I'm not an expert on the majors, but there aren't that many majors left right now. You can take a shotgun approach and really benefit by simply buying the GDX or buying Barrick and Newmont or buying Agnico Eagle, which is still fundamentally undervalued according to long-term metrics, despite the moves that it's had. So I think looking at some of the larger royalty companies, you can't go wrong. But I tend to look at each opportunity on an individual basis, whether it's a drill play, an exploration stock, a development stock, a producer. I look at the merits of each individual, and then I don't really take a thematic approach and drill down into any particular area.
Yes, that makes a lot of sense. And if we could talk very quickly about maybe some of the other commodities that you would be interested in, maybe things like copper, uranium, or anything else?
Yeah, we live in a remarkable time where there are tremendous long-term secular bull markets in play and very bullish arguments for commodities across the board. The commodities in general, I think we're seeing a fundamental shift from financials into commodities. Base metals, energy metals, battery metals, I think every one has its own fundamental supply-demand story that's extremely compelling, completely separate and apart from the very compelling monetary arguments for gold and silver. Every other metal out there has something to be said for it. I'm particularly enthused about copper because I don't think you can really innovate around copper. Copper's important in the end use of electricity and motor windings, and in being employed in appliances and everything else. But it's also critical to the delivery of energy through the grid, and you can't get around copper. So I think copper's a wonderful long-term story. You can buy good copper plays. There's not as many in my mind as you can find, say, in the gold and silver market, but there are some wonderful copper plays out there that I think, can just buy and forget about for a few years and play that long-term trend. Yeah, there are exciting copper discoveries that are made. We've seen some in our portfolio, but they're generally not as dynamic as the gold discoveries. So I think it's one of those things you try to just allocate a portion of your portfolio for copper and forget about it for a few years, and I think you'll be greatly rewarded from that.
And would you be interested in the uranium market as well?
Yeah, always interested in uranium. It is another fundamental story that we've been arguing. This is the year for uranium for, I think, 15 years now, or since Fukushima, and I think it's still the case. I think it's actually much more imminent now. So we always keep some uranium exposure in our portfolio. It's had a few false starts, but uranium has made a really important transition in the investing public's mind, in in the geopolitical arena, in that it's now regarded as a green energy. So a number of the countries that have lobbied against uranium, nuclear energy rather, for years are now looking at it as being um, their uh, their life reserve to get out of more carbon intensive energy sources. So yeah, I think uranium has turned a corner, and we do focus on that in the portfolio as well.
Okay. And so from all these interviews that I do, people sort of don't talk about platinum as much as that they do about gold and silver. So would you be interested in platinum? And do you believe it still has that precious metal side, or is it more industrial metal right now?
Yeah, I think that whatever monetary cachet that platinum and palladium ever had, I think that's fallen by the wayside. I think they are purely industrial metals, arguably critical metals now, with their own specific uses that are, largely irreplaceable as well. Platinum and palladium demand is still growing because internal combustion engines, which are such a large part of the demand for PGMs, that demand is actually still growing despite all the hype and bluster that we see about electric vehicles and the like. The demand for ICE engines is still growing. But the primary issue, the primary factor for platinum and palladium comes not so much from the demand side, but the supply side. It's harder to find platinum and palladium deposits. They're in the areas of the world where you do find deposits that are rich and large enough to produce are in some of the riskier, less secure areas of the world. So it's really, in my view, more of a supply issue than a demand issue. That for that reason, it's harder to find really good equities, junior equities in that space.
Mhm. So Brian, just before we wrap up, I'd like to ask this question for the younger audience. So if we have an individual who's still at the beginning of his or her wealth building path, with so many different options, so many different sectors, what advice would you have for that person so that they can start, building well, getting involved with investing, but also not make too many mistakes?
Yeah, I tell people uh, always to begin with physical metals. Get some physical metals component to protect your wealth. Every dollar or other unit of currency that you put into gold or silver, you are protecting against a almost certain depreciation of purchasing power over the years to come. So whatever you can put in physical metals, have them somewhat accessible, have them not in a bank safe deposit box. And then, to whatever degree you can, and it's practical, expand that through other holdings that may be less accessible, but have a significant portion of your wealth protected from the purchasing power depreciation by having it in physical gold and silver. Beyond that, recognizing that the macroeconomic picture is so bullish for the metals, and the fact that the mining equities, from the exploration place through to the producers, still are so undervalued. I think that's a great way to build wealth. But it is an area that, for better or worse, you need to be educated in. That's both in a feature and a bug. You have to really learn about the sector if you're going to play in it. If you're going to do anything beyond buying GDX and GDXJ, you really need to educate yourself. There are a lot of sources out there. We have a free report on our website at goldnewsletter.com, an investor's guide to gold and silver. It's 40 some odd pages. It's extremely objective, tells you about all the conferences you should go to, all of the newsletters that I believe you should subscribe to. So you have to dedicate some time and energy, and frankly, a bit of money to learn about the sector and educate yourself. But if you do that, the fact that it is an inefficient sector is you can put that to your advantage. You can find some really extraordinary opportunities that the market temporarily overlooks or hasn't realized yet, and get on top of those, and the gains can be extraordinary, especially in a market like this where rising metal prices are supporting uh, even the worst stocks along with the best ones. So it decreases your downside risk while it boosts your upside potential. So I think that's a very exciting area that if you have the capability of devoting a risk portion, a higher risk portion of your investment portfolio to the sector, then it can be a lot of fun and highly rewarding.
Yep. Thank you very much for that. So these are all the questions I had. Is there anything else that maybe you would like to mention that we haven't covered?
Well, I just like to stress to people that this is, again, the kind of opportunity in my 40 some odd years in the industry, I've never seen anything like this. We have a bull market in place. We have a gold price that's likely headed significantly higher for a number of reasons. We have silver that has yet to really leverage gold or get to a fair valuation relative to gold. We have mining stocks in the same boat. So there's tremendous opportunity there to get involved and to really build wealth while you're protecting it. So I would encourage anyone not to let this opportunity get by. Go to the conferences out there, and I'm at most of them. So, feel free to, if you see me, grab me and talk to me, but always happy to talk to people about the tremendous opportunity in this sector. Subscribe to newsletters. There are surprisingly, well, whether surprising or not, there are fewer real newsletters out there that give objective advice, only about a handful or so. And we list all of those in that report. So find those, subscribe to them, subscribe to at least a few of them to really get up to speed on this opportunity, because it is a generational opportunity, something we may never see again in our investing careers. So take advantage of it.
Hmm. So Brian, these are all the questions I had. I have really enjoyed this conversation and thank you so much for your time.
Wonderful. Great to talk with you.